if you're listening to this, you're inherently curious. You want to understand how things actually work, especially when it comes to your money.
Exactly. And today we're getting into something that sounds, honestly, like a bowl of alphabet soup.
Oh, it really does.
SIP, STP, SWP. I mean, the financial world just loves acronyms, right?
They really do. But today's mission is to cut through all that jargon. We want to show you how these three tools basically represent the entire life cycle of wealth.
Yeah, because investing isn't just, picking a fund and sitting on it. It's about how you maneuver your capital through three really distinct phases.
Right. Accumulation, transition, and distribution. And to help us connect all these dots, we've brought the perfect expert to be our voice of reason.
Happy to be here.
So we've got a fantastic stack of sources for this deep dive. We're pulling from a 2026 academic study out of the Journal of Advanced and Future Research, a really fascinating 2025 socioeconomic paper from Pranjana, some regional insights from a Telugu ETV Andhra Pradesh broadcast, and market strategy guides from platforms like ICICI, Grow, and ET Money.
It's a really diverse mix of data.
It is. And the goal here isn't just to define terms. It's to give you the ultimate shortcut to understanding how money actually moves so you can avoid the anxiety of trying to time the market.
Yeah, because market timing is, well, it's usually a disaster.
Exactly. So, okay, let's unpack this. We have to start at the foundation, right? Phase one, accumulation.
Right. Before you can transition or distribute wealth, you have to actually build it.
Makes sense. And that is where the Systematic Investment Plan comes in, the famous SIP. Basically, it's just the act of investing a fixed amount of money at regular intervals.
Which sounds simple, but the mechanics underneath are incredibly powerful.
Yeah, and the barrier to entry is so low now. I mean, the ETV Andhra Pradesh broadcast highlighted that you can start a SEPI with as little as 1,000 rupees.
Yeah, and it relies so heavily on compounding interest, which is why starting early is key.
I always like to think of it like a financial gym subscription. You don't get strong by walking in once a year and trying to deadlift 500 pounds.
Right. You probably just hurt yourself.
Exactly. You get strong by lifting a little bit every single week, consistently.
I love that analogy.
Yeah.
And the academic data totally backs up that younger investors are catching on to this.
Oh, from the J.I. Hare study?
Yeah, the 2026 study by Buddy Nandini.
Yeah.
They surveyed 150 respondents, right? And the S&P is overwhelmingly the most preferred option.
Really? Like across the board?
Especially among the 18 to 35 age group. And what's interesting is many of them are investing under 5,000 rupees a month.
Wow, so it really is that slow and steady gym routine. But why does it work so well, mathematically speaking?
It's all about Rupee Cost Averaging.
All right.
Or RCA.
Right.
Basically, when the market is down, your fixed 5,000 rupees buys you more units of the mutual fund.
Because they're on sale.
Exactly. And when the market is up, that same amount naturally buys fewer units.
So you're automatically buying more when it's cheap and less when it's expensive.
Exactly. If we connect this to the bigger picture, SIPs offer profound psychological comfort.
How so?
Well, it removes the emotion from investing. You don't have to wake up and read the news and panic about whether it's a good day to buy. The discipline is automated.
Right. Which is great when you're 25 and just setting aside part of your monthly salary. But life isn't always a neat monthly schedule.
No, it definitely isn't.
Which brings us to the transition phase. What happens when you suddenly get a large chunk of money, like an inheritance, an annual bonus, or you sell a house? A tiny monthly SIP just won't cut it.
No, and suddenly you have a new problem. How do you get that big lump sum into the market safely? Which is where the Systematic Transfer Plan comes in, the STP.
Right. And to understand why this is so relevant right now, we have to look at that 2025 Pranjana study. This absolutely fascinated me.
The Bihar case study, right?
Yes. So Bihar's economy is currently undergoing this massive shift. It's moving from a deeply agrarian base to a service-driven model.
Driven by all those huge infrastructure investments.
Exactly. Roads, rail, digital connectivity. And because of this, land values are skyrocketing. So families who have held on to farmland for generations are suddenly selling.
Right, so they're converting highly illiquid wealth, like land, into massive liquid lump sums of cash overnight.
Yeah. And as they gain this wealth, they're looking for modern investment strategies. Because if they just leave it in the bank, inflation eats it.
But if they dump it all into the stock market on a Tuesday and the market crashes on Wednesday,
then they lose a fortune.
Exactly. That's what we call entry risk. So they're using STPs to safely move that money.
Okay, so walk me through how an STP actually works in that scenario. Let's say I just sold property and I have 50 lakh in cash.
Okay, so with an STP, you take that 50 lakh lump sum and you park it in a low-risk liquid fund or a debt fund.
Okay, something stable.
Right. And then within the same asset management company, you set up an automated transfer. So every month, a fixed amount, say 5 lakh, moves from the safe debt fund into a volatile equity fund.
Oh, I see. So it's basically Rupee Cost Averaging on steroids.
It is, for lump sums, yeah.
But wait, I have to play devil's advocate here.
Go for it.
Wait, if the stock market historically goes up over the long term, why not just dump the whole lump sum into the equity fund on day one? Aren't we just leaving money on the table by dripping it in slowly?
This raises an important question. And you're right, statistically, in a perfectly rational market over 20 years, a lump sum often beats dripping it in.
Right. So why use the STP?
Because we don't live in a spreadsheet. We live in a reality where market timing is impossible. If you dump your 50 lakh in the day before a global crisis hits, your capital is decimated.
And it might take years just to break even.
Exactly. An STP is an insurance policy against catastrophic early losses.
That makes a lot of sense. You're trading a little bit of absolute peak return for peace of mind. But there's a catch here, isn't there? I saw a huge warning in the ET Money and Grow guides.
Ah, yes. The tax drag.
Yeah, explain this because I think a lot of people miss this detail.
It's crucial. When you set up an STP, it feels like you're just sliding money from one folder to another.
It feels seamless.
But to the tax department, every single transfer is treated as a redemption from the source fund.
Wait, really? Every single month?
Yes. The mutual fund company is actually selling units of your debt fund to buy units of the equity fund.
Meaning it triggers capital gains tax on each transfer.
Exactly.
Yeah.
Specifically, short-term capital gains tax on the debt fund, which is added to your taxable income.
Wow. So if you're in the 30% tax bracket, you are paying a hefty premium just to transition your money safely.
You are, which is why you have to view an STP strictly as a risk mitigation tool, not a profit generator.
Okay, so we've accumulated wealth with SIPs in our 20s and 30s. We've managed our bonuses in our 40s using STPs.
And now we arrive at the final phase.
Right, the distribution phase. You're nearing retirement, or maybe you need to pay your child's college tuition. How do you get the money out without completely destroying your portfolio?
Enter the Systematic Withdrawal Plan, the SWP.
The SWP, which is basically the exact opposite of an SIP.
Exactly. Instead of putting a fixed amount in every month, you withdraw a fixed amount regularly.
So the mutual fund company just sells the required number of units at the current net asset value to generate your cash, right?
And the rest of your money stays invested and keeps growing.
Here's where it gets really interesting. I was trying to visualize this, and the best analogy I could think of is an apple orchard.
Okay, I like where this is going.
Imagine you've spent 30 years growing this massive apple orchard. That's your portfolio. If you retire and just withdraw a huge lump sum, it's like taking a chainsaw and chopping down the entire tree.
Right, you get a ton of apples today, but the tree is gone. It can never grow more apples.
Exactly. But an SWP allows you to just walk into the orchard every month and pick the exact number of apples you need to survive.
Leaving the tree totally intact.
Yes, so the tree keeps growing, producing new apples, and fighting off the inflation bugs.
That's a brilliant way to look at it. And the math behind why an SWP is so powerful really comes down to taxes.
Oh, the tax magic. This part is mind-blowing. Because a lot of people just put their retirement money in a fixed deposit, right?
Yeah, a traditional FD for monthly income. But with an FD, every single rupee of interest you earn is taxed as income.
Based on your slab rate?
Exactly. But with an SWP, it's entirely different. Only the capital gains portion of each withdrawal is taxed.
Wait, break that down for me.
So when you withdraw money, part of it is the original principal you invested, and part of it is the profit. The government doesn't tax you on your own principal.
Oh, right, because it was already yours.
Exactly. They only tax the profit. And it gets better. Long-term capital gains on equity funds.
Meaning you've held the units for over a year?
Right. Those gains are tax-free up to 1.25 lakh rupees in a single financial year.
That is huge.
And even if your profit exceeds that 1.25 lakh, it's only taxed at a flat rate of 12.5%.
Compared to maybe 30% in an FD, that is incredibly tax efficient. How a fixed deposit is taxed versus how an SWP is taxed is absolutely staggering when you break down the math.
Walk me through that math, because to most people, income is just income. Why does the government treat it differently?
Let's look at the fixed deposit first. If you put 1 crore in the bank and it generates, say, 700,000 rupees of interest a year,
Yeah.
Every single rupee of that interest is added to your total taxable income. If you are in a 30% highest tax bracket, you are losing nearly a third of your interest straight to the government before you even get to spend it.
Ouch. That eats into your lifestyle pretty fast.
It really does. Now look at the SWP. When you withdraw 50,000 rupees a month from your mutual fund, you are not just withdrawing profit or interest.
What else is in there?
You are withdrawing a mix of your original principal investment, the money you already paid taxes on decades ago when you earned it, plus the gains that those specific units made over time.
Okay, let me make sure I'm getting this right. If I pull out 50,000 rupees today, the mutual fund calculates that, say, 40,000 of that is my original money, and 10,000 of it is the profit those units generated over the years.
Yes. And here is the kicker. You do not pay any tax on the 40,000 rupees of principal. That is your money.
Wait, really?
Really, you only pay capital gains tax on the 10,000 rupees of profit.
Wow. So my taxable footprint for the month isn't 50,000. It's only 10,000.
Exact.
And capital gain tax rates are generally much lower than highest income tax slabs, right?
Considerably lower, so your tax burden shrinks dramatically. Meanwhile, the unwithdrawn balance of your money, the 99.5 lakhs still sitting in the fund, stays invested in the market, continuing to compound.
That's wild.
Very often, if your monthly withdrawal rate is lower than the fund's overall annual growth rate, your portfolio can actually continue to increase in total value even while paying you a monthly salary.
That is incredible. You are getting paid, and the mountain is still growing. But there is a massive risk we have to talk about.
Right. It's not all sunshine and tax breaks. The guides call it the sequence of returns risk.
Yes, this is the ultimate danger of the distribution phase.
So what happens? Let's say I'm withdrawing my fixed amount every month, but the market crashes early in my retirement.
Well, if the market crashes, the net asset value of your fund drops significantly. But you still need your fixed 50,000 rupees a month to pay your bills, right?
Right. My groceries don't get cheaper just because the stock market is down.
Exactly. So to get that same 50,000 rupees, the mutual fund company is forced to sell a massive number of units because each unit is worth so much less.
Oh, wow.
You're liquidating huge chunks of your portfolio at rock bottom prices.
Which means when the market eventually recovers,
You don't have enough units left to capture the growth. It can prematurely drain your entire portfolio to zero.
that is terrifying. So how do we prevent that?
The rule of thumb across all the strategy guides is to keep your withdrawal rate very conservative,
What's the number?
usually around 4% to 7% of your initial corpus annually. If you withdraw more than the fund's historical growth rate minus inflation, you're cannibalizing your principal.
Right. You're picking apples faster than the tree can grow them.
Exactly.
Okay, so we've got the SIP for accumulation, STP for transition, and SWP for distribution. But how do you actually move from one phase to the next in the real world?
That is where people really stumble.
Yeah, because I was looking at platform guides, like for Zeroda, and it turns out an SIP does not automatically convert into an SWP when you hit a certain age.
No, not at all. It's a completely manual switch.
You actually have to log in, manually stop the SIP, wait for all your units to settle in your account.
Which takes a few days.
Right. And only then can you register a new mandate for the SWP.
It requires intentional action. And this ties perfectly back to that 2026 JAFR study.
The awareness gap.
Exactly. The financial industry has spent billions marketing SIPs. Everyone knows how to put money in.
But awareness of SWPs and STTs is shockingly low.
It really is. The biggest mistake investors make isn't picking the wrong mutual fund. It's using the wrong systematic tool at the wrong time.
Like starting an SWP before your corpus is actually big enough to sustain it.
Or totally ignoring inflation when setting your withdrawal amount.
Or honestly panic stopping an SIP during a market crash.
Which completely ruins the entire benefit of Rupee Cost Averaging.
So what does this all mean for you, the listener? By understanding these three tools today, you are already light years ahead of the average investor.
Absolutely. You now know not just how to build the engine, but how to install the brakes and harness the output.
Perfectly said. SIP builds the wealth systematically. STP transitions your lump sums safely without entry risk. And SWP extracts your income efficiently and saves you a ton on taxes.
It's the complete toolkit.
It is. But I want to leave you with a final, slightly provocative thought to chew on. These systems, because they automate our financial lives, right?
Right, they remove human emotion from the equation.
Exactly. But if our entire financial life cycle is running on autopilot, does that automation lull us into a false sense of security?
Oh, that's an interesting point.
I mean, when the macroeconomic environment structurally changes, like if inflation stays historically high for a decade, Will we be too comfortable to notice? Will we realize that we actually need to grab this steering wheel and adjust the system?
It's the danger of set it and forget it. You can't just close your eyes for 30 years.
Exactly. You still have to be the pilot.
Automation is a tool, not a replacement for awareness.
Beautifully put. I highly encourage you to look at your own portfolio this week. Figure out which phase of the alphabet soup you're currently swimming in, and make sure you're using the right tool for the job.
Thanks for having me.
We'll see you next time.